In the heart of Washington, D.C., monuments of marble and granite stand as enduring symbols of American power and prosperity. For generations they have represented a promise of stability, a beacon of economic strength for the entire world. But beneath this veneer of permanence, a silent, corrosive force is at work, hollowing out the very foundations of that strength. It's a crisis that doesn't arrive with a bang, but with the relentless, quiet tick of a calculator. A crisis of debt. By mid-2025, America crossed a brutal and once unthinkable milestone. Over $1 trillion spent in a single year, not on building roads, not on funding research, not on national defense, but on interest payments for our national debt. To put that in perspective, this colossal sum is now more than the entire federal budget for Medicaid, which provides health care for over 85 million Americans. It's a gargantuan tribute paid to the past, consuming the resources we desperately need for our future. This isn't just an accounting entry, it's a profound statement about our national priorities, where servicing yesterday's borrowing now outweighs caring for our most vulnerable citizens today, and the bleeding is only accelerating. By the end of the year, that figure will surge past $1.2 trillion. This catapults interest into the top tier of government expenditures, making it the second largest item in the entire federal budget, trailing only Social Security. Think about that. The cost of our borrowing will soon eclipse what we spend on the entire U.S. military. This is the chilling arithmetic of a fiscal doom loop. We are now borrowing money simply to pay the interest on the money we've already borrowed. Each new dollar of debt adds to the principal, which in turn generates even higher interest payments, which then requires even more borrowing. It's a self-perpetuating cycle, a vortex from which it becomes exponentially harder to escape. The speed of this accumulation is breathtaking. The nation's debt stood at $34 trillion at the dawn of 2024. Barely a year later, it has blown past $37 trillion. It took the United States over 2 centuries to accumulate its first $1 trillion in debt. Today, analysts warn the U.S. is adding a new trillion to the pile every 5 months, a pace twice as fast as the already alarming historical average. This isn't a distant, abstract problem for future generations anymore. The future is now, and the bill has come due. The primary drivers are a toxic cocktail of legacy spending programs, recent emergency measures like the pandemic relief packages, and a fundamental structural mismatch between what the government collects in taxes and what it has promised to spend. The consequences of this fiscal recklessness are not confined to the ledgers in Washington. They are cascading down to every American household. The federal government's insatiable appetite for borrowed money forces it to compete with its own citizens for capital. This crowding out effect drives up the cost of money for everyone. That's why mortgages are more expensive, making the dream of homeownership a nightmare for a new generation. It's why car loans are costlier, adding hundreds of dollars to monthly payments. For entrepreneurs, the lifeblood of the economy, it means business loans needed for expansion and hiring are harder to get and more expensive to service. This stifles innovation and job creation. For everyone, it means weaker investment returns and slower wage growth, as the economy groans under the weight of unproductive government debt, all while persistent inflation, fueled in part by this deficit spending, erodes the value of every dollar earned. And while American families are forced to tighten their belts, Congress continues to pile on more spending. This is not a partisan failure, it is a bipartisan catastrophe. For decades, both parties have chosen the path of least resistance. Republican-led initiatives like the 2017 tax cuts added trillions to the debt without corresponding spending cuts. The Congressional Budget Office estimates those cuts will add another $4.1 trillion over the next decade alone. Simultaneously, Democrat-led administrations have championed massive spending bills on infrastructure, green energy, and social programs, also financed largely with borrowed money. Each side blames the other, engaging in high-stakes political theater during debt ceiling negotiations, only to ultimately sign off on more spending and kick the can down a rapidly shortening road. The political will to make hard choices has vanished, replaced by a shared addiction to deficit financing. The long-term trajectory is terrifying. The nonpartisan CBO projects that U.S. debt held by the public will reach an unprecedented 156% of our entire economic output by 2055. This is territory occupied by nations that have experienced severe economic stagnation or collapse. For decades, America has benefited from the US dollar's status as the world's reserve currency, allowing us to borrow at lower rates. But as our debt grows and our political system appears incapable of addressing it, faith in the dollar could erode. Foreign creditors may demand higher interest rates or worse, stop buying our debt altogether. This could trigger a sovereign debt crisis, leading to a sudden brutal adjustment, draconian cuts to Social Security and Medicare, crippling tax hikes, and a permanent decline in America's standing in the world. The path we are on is unsustainable. The question is no longer if a reckoning will come, but what form it will take, and whether we will have the courage to change course before the choice is no longer ours to make. The era of quiet confidence in the bond markets is over. The calm has been shattered. For years, US government debt was the safest asset on the planet, a bedrock of the global financial system. But now, a seismic shift is underway. Treasury yields, the interest rate the US government pays to borrow, are surging to levels not seen since the eve of the 2008 financial crisis. This isn't a minor fluctuation, it's a fundamental repricing of risk. Global investors are looking at the sheer volume of debt being issued and are demanding a much higher premium. They're asking a simple yet terrifying question: is our money still as safe as it used to be? This isn't an abstract problem for Wall Street. These higher yields translate directly into more expensive mortgages, car loans, and credit card debt for everyday Americans, squeezing household budgets and slowing the economy. This anxiety is now validated by the financial world's most powerful auditors, the credit rating agencies. In a move that sent shockwaves through markets, Fitch Ratings downgraded the US government's creditworthiness from its pristine AAA status, citing fiscal deterioration and a dysfunctional political climate. The agencies, once monolithic, are now fractured. S&P attempts to find a silver lining, suggesting protectionist tariffs could bolster domestic industry. But this view is increasingly isolated. Moody's offers a far more chilling analysis, pointing to a grim fiscal milestone. The amount the U.S. spends on interest payments has officially surpassed the entire national defense budget. More taxpayer money now goes to service old debt than to fund the Army, Navy, Air Force, and Marines combined. This isn't just an accounting issue, it's a national security crisis in the making, forcing a radical re-evaluation of America's priorities. This crushing fiscal pressure inevitably spills beyond domestic balance sheets, reshaping America's role in the world. A nation drowning in interest payments has less capacity for foreign aid, less appetite for military intervention, and less leverage in diplomatic negotiations. Its power is constrained not by rivals, but by its own accountants. In this environment, foreign policy becomes a function of economic necessity. Consider the push by figures like Donald Trump for accelerated peace talks with Vladimir Putin. Viewed through the prism of the debt crisis, a different logic emerges. The objective extends beyond simply ending the war. It's a calculated gambit to stabilize the global economy by reintegrating Russia's vast resources. Reopening access to Russian oil, natural gas, and fertilizers could theoretically slash energy prices, tame inflation back home, and ease the supply chain bottlenecks crippling American businesses. It's a stark example of how a superpower's domestic economic weakness can force it to consider compromises that were once unthinkable. The geopolitical reverberations would be immense. For America's European allies, it signals a terrifying risk: the potential withdrawal of the US security umbrella, leaving the continent vulnerable. For Ukraine, the word is not risk, it is betrayal, a sacrifice on the altar of lower gas prices. Other global powers watch with keen interest. China, America's primary strategic competitor, sees a rival potentially hobbled, not by military defeat, but by self-inflicted financial wounds. But in the end, the bond markets are the most ruthless observers. They don't trade in ideology or morality, they trade in numbers. And the numbers tell a simple, brutal story. A superpower, the architect of the modern global order, is straining under the colossal weight of its own interest bill. The world isn't just watching a financial crisis, it's watching the very foundation of American power begin to crack. In this new order, debt itself has become a global actor, a silent, invisible sovereign with no flag, yet its influence dictates terms to the world's most powerful nations. This isn't just accounting, it's about power. The global trade in sovereign debt has woven a complex web of interdependency, where a tremor in one market can trigger a tsunami across the entire system, holding the world economy hostage. The battlefield is fiscal, the weapon is interest. In this silent war, the front lines are not on maps, but on the screens of trading floors and in the boardrooms of central banks. The combatants are a new kind of army: bond traders, credit rating agencies, and foreign creditors. Every basis point hike is a strategic strike, siphoning resources from vital public services. It's a war of attrition where the casualties are the prosperity of future generations. And so, America's negotiations are less about borders than about buying time from collapse. The primary negotiation is no longer with foreign rivals, but with our creditors over terms of repayment. It's a desperate, ongoing negotiation with the future itself. Every political battle over the budget, every last-minute deal to raise the debt ceiling, is not a sign of strength, but a frantic effort to kick the can down a rapidly shortening road. We are no longer charting a course, but simply trying to postpone a catastrophic financial reckoning.